Many people believe that investing is all about picking the right stocks, timing the market, and following complex strategies. But what if I tell you that even Mr. Warren Buffett recommends a much simpler way to build wealth? He recommends the best long-term investment for most people is a low-cost index fund, which means no stock picking, no market timing, no complicated strategies. Well, if the strategy is so simple, then why isn't everyone following it? Let's break it down and understand how you can make a simple yet highly effective portfolio. First, let's understand what is the purpose of investing. In simple words, it means wealth creation with low risk and high returns over time. Then why do most investors fail? Simply because they chase high risk stocks, try to time the market, which rarely works, and lastly they pay high fees for actively managed funds. The solution to this is a simple, low cost passive strategy that builds long-term wealth without daily tracking. And that's exactly what the 3-fund portfolio does. A 3-fund portfolio is a globally diversified passive investing strategy using just 3 index funds, which in India can be having 3 funds in your portfolio, which contains one broad-based Indian equity market index fund, which invests in India's top companies via Nifty 50 or Sensex index funds. As a result, no need to pick individual stocks. This fund automatically tracks the best performing companies. Having one international equity market index fund, which provides exposure to US or global markets and companies like Apple, Google, Amazon. Even if the Indian markets underperform, global growth keeps your portfolio balanced. Lastly, having one bond index fund, which would provide stability when the markets crash. These 3 funds together create a well-diversified portfolio covering Indian and global markets while maintaining stability. Now you would be thinking, why is this strategy so powerful? Let's break it down. First reason is that the market always grows over time. S&P 500 is US broad-based index fund, has delivered 10% average annual returns for more than 50 years. Also, Indian broad-based index Nifty 50 has also grown on an average by 12 to 14% per year historically. Even if the market crashes, it eventually recovers and grows. Second reason is that passive investing beats 90% of active investors. Once Warren Buffett took a $1 million bet that an S&P 500 index fund would beat hedge funds over 10-year period. The result was that he actually won the bet. Active investing is equal to time, skill and luck. Passive investing is equal to works for everyone. Third reason is that diversification lowers risk. Never put all your money in one single stock. The 3-fund portfolio spreads risk across hundreds of companies worldwide. In short, this is the simplest yet most effective way to build wealth. Now, how can we apply this strategy in India? Making a portfolio with one broad-based Indian equity-oriented mutual fund which tracks Nifty 50 or Sensex. You can allocate 50 to 70% of your investments in this fund depending upon your risk appetite and goals. Few examples of index funds are a Nifty 50 index fund, the Sensex index fund. Next, you can have in this portfolio one international equity-oriented index fund which tracks broad-based index of a developed country like S&P 500 or Nasdaq. You can allocate 20 to 30% of your portfolio investments here depending upon your risk appetite and goals. Few examples of this international index funds could be S&P 500 index fund, Nasdaq 100 index fund. Lastly, having one bond or debt-oriented mutual fund in your portfolio where you can allocate 10 to 20% of your investments. Few examples are gilt fund, corporate bond fund. Invest in these funds regularly in the form of monthly SIPs to avoid market timing. Also, rebalance your portfolio annually. Maintain 50 to 70% Indian stocks, 20 to 30% global, and 10 to 20% of bonds. Even Mr. Warren Buffett follows this strategy. For managing his family's portfolio, 90% of his wealth is to be invested in an S&P 500 index fund and balance 10% in bonds for stability. If a billionaire trusts this strategy, shouldn't we as well understand the strategy and use it to our own advantage? Now, some people might think that only 3 funds, is that enough? Answer to this is simply yes, because these funds cover hundreds of companies, so no extra diversification needed. Also, it's beginner friendly, so no stock picking needed. Even if markets crash, they do recover. The key is to invest for long term. If you want financial freedom without tracking the markets daily, this is the strategy you can consider investing in. To recap, you can make a simple yet high performing 3-fund portfolio in India by investing 50 to 70% of your portfolio in Indian broad-based index funds, which is Nifty 50 or Sensex. For Indian market growth, invest 20 to 30% in S&P 500 or Nasdaq 100 fund for global diversification and balance in bond or debt fund for stability and protection. Wealth creation is not about complexity. day. It's about consistency. Follow this strategy, stay invested, and let compounding do the work for you. What is stopping you from passive investing? Comment your answers down below. If you found this video helpful, do consider to like and share it with someone who needs this. Also subscribe to my channel for more simple and effective investment strategies. With that said, I will see you in the next one. Thank you.